100 baggers are essentially companies that are compounding machines. Also remember that sometimes you'll find companies that have high returns on capital, but they don't have many opportunities to actually reinvest back into the business. Maybe they've tapped out the market they're in, or the market they're in is just too mature. You need to both have high return on capital and the long runway to continue to make those reinvestments for long periods of time. In today's episode, we are going to be covering my biggest takeaways from Chris Mayer's book, 100 Baggers, and how investors can find companies that increase their initial investment by 100 times. In this video, you'll learn what a 100 bagger is. We'll be chatting about the strategy of the coffee can portfolio. We'll walk through a 100 bagger case study. We'll cover the 6 characteristics of 100 baggers, as well as the caveats and important considerations in implementing this sort of investment strategy. With that, let's get right to it. So first off, I think we should define what a 100 bagger is. This idea of 100 baggers, it originated from legendary investor Peter Lynch. In his books, he oftentimes referred to things like 5 baggers and 10 baggers, including his book, One Up on Wall Street. 100 baggers are simply stocks that have increased by 100 times. So for every dollar you put in, you get back $100. So if you invested $10,000 into a company and it compounded, became a big winner, and it became a 100 bagger, then you would have $1 million. This of course takes time, and it obviously can't be expected to happen overnight. One of the amazing things about investing in the stock market is that if you can pick up one of these really big winners, then it can really make a massive difference in the overall returns in your portfolio. Remember that when you invest in a stock, the most money that you can lose is whatever you put into it. So let's use the example that assuming you aren't using any leverage, and if you invest, say, $10,000, then the most money that you could lose would be that $10,000 that you put in. But your upside is unlimited. So if you have 5 stocks, say 4 of them go to zero, and one of them happens to become a 100 bagger, then you still have a fantastic result, all things considered. But nobody said that finding 100 baggers and achieving this in your own portfolio was easy. Very, very few people can end up doing it, and very few companies are able to achieve this level of success. So during this video, I'll be sharing some of the nuggets I picked up from reading Chris's wonderful book, 100 Baggers, and hopefully you learn a thing or two about finding these really big winners. So Thomas Phelps, in his book, 100 to 1 in the Stock Market, he performed a study that looked at companies that increased by 100 times from 1937 through 1972. And this happened to be one of Chris Mayer's favorite investment books, so Chris decided that he was going to update the study since it's been many years since that study was done. Chris actually ended up dedicating his book to Thomas Phelps, who passed away in 1992. So Chris's book, 100 Baggers, it studied companies from 1962 through 2014. In his study, he assumed that dividends that were paid out by these companies, they were reinvested, and that helped him determine whether a company made the 100 bagger cut or it did not. So after he filtered out the tiniest stocks that were sort of outliers, he narrowed it down to 365 names. Many of these are companies you know, companies like Walmart, PepsiCo, Coca-Cola, Boeing, Target, and many others that I'm not going to name here. The top performer in the study was none other than Berkshire Hathaway, which at the time of his study had increased by 18,000x. This means that had you invested $10,000 into Berkshire Hathaway at the beginning of the study, it would be worth $180 million. So the first thing to note when looking at these companies that were 100 baggers is that there wasn't one particular type of company or type of industry that really stands out. So there's a big diversity in the names that have seen success. The companies in the study, to no surprise, they tended to start out as pretty small companies. The median market cap of companies at the beginning of the study was only $500 million. So it sort of crushes the myth that you have to start out with some small, obscure microcap to see these extraordinary returns. And then the average amount of time that it took for a company to reach 100 bagger status was 26 years. So like I mentioned, it is not going to happen overnight. Here's a chart on the screen here that shows the distribution of how long it took for each company to increase by 100 times. Around 60 of the companies did so within 15 years, and it looks like most of the companies ended up taking anywhere between 16 to 45 years, which is obviously quite a long time for investing, and that's why it's so important to have that patience, which we'll be talking about later. All right, so next I wanted to talk about the coffee can portfolio. Since the average 100 bagger takes 26 years to pan out, this alone makes it very unlikely that many people aren't ever going to have a 100 bagger. And that's for the sole reason that they don't have the patience and the wherewithal to hold on to a stock for that long. Most investors are really their own worst enemy when it comes to investing, and they end up messing with their portfolios too much and tinkering with it. There was a study that was done by eToro recently, and it found that the average holding period for stocks was 5 years in the 1970s, and in 2022, the average holding period for stocks was just 10 months. People are becoming more and more impatient, and they sort of treat the stock market as a place to gamble and a place to speculate on stock prices rather than treating it as a place that they're investing in real businesses. Chris Mayer writes in his book, "The biggest hurdle to making 100 times your money in a stock, or even just tripling it, may be the ability to stomach the ups and downs and hold on. It takes patience, some savvy stock picking, and as with most things in life, some luck." Now, one way Chris recommends combating the need to tinker with your portfolio is the coffee can approach. In the Old West, people would store their valuable possessions in a coffee can, and they would put this coffee can under their mattress and they just leave it. That's the sort of approach that leads to 100 baggers in a stock portfolio. The idea is that most stocks are going to be pretty average. So if you coffee can 10 to 20 companies and decided that these are great businesses, you're going to have to buy them and hold on to them and not let anything scare you out of them. You just let them compound and give them time to really grow and blossom. Say you do a coffee can portfolio of 10 or 20 names. You may have 1, 2, or maybe even 3, for example, that are really big winners that just lift and they carry the whole portfolio. Walmart would be a prime example of this, where it just consistently compounded at high rates of return, and it did so year after year after year, and it just left most other companies in the dust. In the book, Chris tells the story of one of his readers that set up a coffee can portfolio, and he set up 10 stocks in his portfolio, where 9 of these companies ended up going bankrupt, but it really didn't matter because the 10th company ended up becoming an 800 bagger. And the key was he bought it, and he just held on to it. He didn't tinker with his portfolio. He didn't trade in and out of it. He just held on. If you like the coffee can approach, Chris suggests not taking any startup risks by investing in early stage companies. He prefers sticking with companies that are well established and they have a long runway for growth, and they're able to continue to compound at high rates of return for a really long time. Remember that the only way to have these big multi-baggers is to buy right and hold on. And the coffee can approach can be a nice crutch to help you achieve that. Before we dive into the characteristics to look for in 100 baggers, I wanted to touch on one of the case studies that Chris shares in his book, and the company I wanted to cover here was Monster Beverage. This company became a 100 bagger in under 10 years, and by the end of 2014, it actually became a 700 bagger. A couple of immigrant entrepreneurs purchased Hansen's Natural Soda in 1992, which would eventually become Monster Beverage, a name which I'm sure you're probably aware of. It wasn't until their 2001 proxy they shared their intentions to put their focus on the energy drink market. They launched Hansen Energy, and it initially was a pretty big hit, but it just got overtaken by Red Bull pretty quickly. And then in 2002, they launched Monster Energy. And they narrowed their focus to just a few products, whereas before they had a vast array of products and they weren't seeing a lot of success. They learned from their prior mistakes, and they learned from what Red Bull did with all the spending they did on marketing, and it paid off really well for them. So from 2002 through 2006, you can see that Monster continued to spend more and more on sales and marketing, and they spent a lot of time trying to get that shelf space they needed to continue to expand and continue to grow. They were also really crafty in releasing new products, and they ensured that these products would appeal to their target market, which was typically men. It was pretty easy to see Monster's success in their financials. In 2002, they had sales of $92 million, and by 2008, their sales crossed $1 billion. As their products saw big success, it started to feed on itself. Their distribution partners liked working with them because they had a great product that sold, and then this naturally led to more partnerships. And then they hit economies of scale and they saw their margins expand as they didn't need to spend much on marketing relative to how much their sales were growing. And then obviously this led to a rocketing stock price. And to benefit from that share growth as investors, you really didn't have to get into the stock at the very beginning. You could have hopped along for the ride in, say, 2004, once this company started to see some success, and you still could have had a 100 bagger down the road. Another piece I found really interesting with this case study was that people probably assumed that Monster's stock was really expensive. But the chart here that Chris showed in his book was that it actually never was really at a ridiculously high valuation. Its PE multiple tended to trade around 30 most years, as this chart shows. And then Chris rounded out this case study on Monster with the following quote: "Monster shows us the power of high sales growth in building a brand in the potent mix of high sales growth, rising profit margins, and rising return on equity. It also shows you how independent-minded you had to be. There was no shortage of smart people telling you why Monster wouldn't work. But it did work, and in spectacular fashion." Now that we've covered the study that Chris conducted as well as a case study, let's talk about the characteristics of 100 baggers that Chris Mayer found. This is one of the main reasons we want to study previous 100 baggers in the first place. We want to look back at history and see if there are any common themes we can pick up in searching for potential big winners of the future. Now, this is totally obvious and intuitive, but the first ingredient of 100 baggers is that they typically started out as small companies. If you want these big multi-baggers, the first companies to cross off your list are the biggest companies. The Apples, the Microsofts, the Walmarts of the world. Companies that are already very big companies. It's pretty incomprehensible to think that a $1 trillion company today is going to turn into a $100 trillion company in the future. Now, that's not to say that these companies can't be great investments, but when you look out over the next 10, 20, 30 years, you're going to see much higher levels of growth in great businesses that are much smaller, and they have a lot more room to run in the future. And remember that Apple and Microsoft at some point in their history were pretty small companies, and some investors had the patience, the fortitude, and the foresight to take advantage of the opportunity that laid ahead for these great businesses. The second ingredient you need to have a 100 bagger is growth, growth, and more growth. A company might be a small part of a growing market, but one way or another, it needs a long runway to grow. To use Amazon as an example, when they got going, they started out, of course, as an online retailer. Originally, they just started out with books. It's simple to think about the ways that a company like Amazon could grow at that point. The e-commerce space was growing really fast year after year after year. Amazon itself would be taking an increasing share of that e-commerce space, and then they would create new lines of business like AWS, Amazon Prime, and then they branched out into selling everything instead of selling just books. Now, earnings growth is a primary component of what leads to an increasing stock price, but another important factor to consider here is the multiple that the company is trading at. If you buy a business at, say, a multiple of 15 times earnings, and over a few years the multiple goes to 30 times earnings, then you've seen the stock double just from the multiple expanding from 15 to 30. That means instead of needing the earnings to increase by 100 times to get that 100 bagger status, you only need the earnings to increase by 50 times, assuming that the stock stays at a multiple of 30 in this example. This combination of earnings growth and multiple expansion is what Chris Mayer calls the twin engines for growth. This brings us to the third ingredient, which is also extremely critical and oftentimes overlooked, which is having high returns on capital. What does that mean exactly? Essentially, it means that when a business reinvests back into itself, it earns a high return. There are plenty of ways to measure this. You can look at the return on invested capital, the return on equity, the return on capital employed, The bottom line is that when a business reinvests, it needs to achieve a high rate of return because that is what creates that incredible compounding effect. Charlie Munger has this quote that, quote, "If a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with a fine result," end quote. This is because over the long run, the returns of the stock tend to coincide with the return on the business. We'll pull up a chart here to show you what I mean. So here you'll see that we have two tables of two examples of two businesses. The business on the left compounds at 20% per year, and the business on the right compounds at 6% per year. Each business starts with $1 per share in earnings, but after 10 years, the two businesses end up in completely different places. The first business compounds at 20%, and it ends up with earnings per share of $6.19. And the second business compounds at only 6%, and it ends up with earnings per share of $1.79. That is almost 3.5 times bigger for the company on the left than the company on the right. This is why if you're wanting these big multi-baggers, you need to focus on companies that have high returns on capital. And they have a lot of opportunity to reinvest that capital back into the business. 100 baggers are essentially companies that are compounding machines. Also remember that sometimes you'll find companies that have high returns on capital, but they don't have many opportunities to actually reinvest back into the business. Maybe they've tapped out the market they're in, or the market they're in is just too mature. You need to both have high return on capital and the long runway to continue to make those reinvestments for long periods of time. This means that for big multi-baggers, you want to typically avoid stocks that have a high dividend yield, and avoid getting into a stock just because you believe it's slightly undervalued, but it doesn't have much reinvestment opportunity for the future. But once you do find these great businesses that have high returns on capital and a long runway, it's all a matter of buying them at a reasonable price and just simply hanging on to them. If you find yourself holding a business with high returns on capital, it's almost always a mistake to sell it as long as they're continuing to earn those high returns on capital with its incremental investments back into the business. Also, you might be tempted to purchase a lower quality stock just because it appears to be trading at a cheaper price. And this example highlights the importance of high quality businesses that compound at high rates of return. Keep in mind the Warren Buffett quote that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. To give you a number to help you in your own journey of searching for these types of companies, the 100 baggers in Chris's study tended to have return on equity of at least 15% or better in most years during the study. I just wanted to jump in here and tell you about this new valuable resource that we created for you. The biggest challenge to taking control of your personal finances, improving your investment returns, and building a better future is just getting started. This means getting organized, having a plan, and being disciplined. As Mark Twain once said, the secret to getting ahead is getting started. If you're not satisfied with where you're at financially, whether that be not having enough savings at the end of each month, watching your cash being eroded away by inflation, or maybe you're not sure where to get started with investing, down in the description below, we put together a free guide for you called The 4 Simple Steps to Take Control of Your Personal Finances and Life. You can get this free guide by clicking the link in the description below. All right, let's turn to the fourth key characteristic of the winners that Chris studied, and that is that they tended to be managed by owner-operators. Owner-operators are essentially managers who run the business and own a lot of stock in the company. The reason this is so important is because if the managers own a lot of stock in the business, then their interests are aligned with your interests as shareholders. They go to work every day thinking about how they can best maximize long-term shareholder value. In companies with owner-operators at the helm, they generally tend to outperform the overall market by a pretty wide margin. Oftentimes, you'll find that companies with the highest level of insider ownership have the founders still running the company. Founder-led CEOs also tend to invest more in things like research and development than other CEOs, and they're more focused on building shareholder value rather than doing things like making value-destructive acquisitions. Too many companies nowadays fall prey to outside pressures, whether that be pressure from shareholders or pressure from Wall Street. When the insiders own a lot of stock, they are incentivized to care more about value creation rather than appealing to Wall Street or appealing to other people's interests. When their own personal wealth is at risk, they're not going to be doing silly things like making value destructive acquisitions or pushing for these short-term EPS targets. Chris writes that, quote, "Many of the best performing stocks of the past 50 years had such a key figure for at least part of their history," end quote. You can think about people like Steve Jobs at Apple, Sam Walton at Walmart, Bill Gates at Microsoft, Howard Schultz at Starbucks, or Warren Buffett at Berkshire Hathaway. All right, so the fifth characteristic I wanted to list here is that you typically want to look for companies with lower earnings multiples. Now, this doesn't mean you only look for stocks that are single-digit PEs, because you typically aren't going to find these big winners in that batch. The point is, if you pay a ridiculously high price, such as a PE of 100, then you're making the path to getting that 100 bagger status really, really difficult, because those earnings have to increase by so much if the earnings multiple were to contract. Now, there may be many cases where a really high PE ends up working, but the math tends to work out a lot better when you really make sense of the PE in relation to the company's growth rate and in relation to its runway. So it's really all about a balancing act. You don't want to go too low on the PE spectrum because you won't find too many high quality compounders, and you don't want to go too high because there's already a ton of growth priced into the company. Chris writes that, quote, "Great stocks have a ready fan club, and many will spend most of their time near 52-week highs, as you'd expect. It is rare to get a truly great business at dirt cheap prices," end quote. Like I mentioned earlier, the twin engines of earnings growth plus multiple expansion can be really powerful, so really do not underestimate that either. Once you do get a hold of a great compounder, you want to give it a long leash and let it run. If a business gets a bit overheated in terms of its valuation, Chris actually recommends being a reluctant seller. Remember, it's all about buying right and holding on. Phil Fisher once stated, "If the job has been correctly done when a common stock is purchased, the time to sell it is almost never." Remember that great businesses trade at a premium and oftentimes look really expensive. But when you look back in retrospect, selling a great business is almost always a mistake, as they tend to hit new all-time highs over and over again. And the sixth key ingredient that I wanted to list here is not so much about the company, but for you as the investor. It's patience. In order to own a 100 bagger, you're going to need a tremendous amount of patience. The average 100 bagger took 26 years to achieve such a feat. That's a really long time. So the typical 100 bagger takes 25 to 30 years, but it might take even longer than that. I actually had the honor of chatting with Chris on the We Study Billionaires podcast, and Chris mentioned that he likes to think of companies reaching the 100 bagger status almost as a math problem. If a company grows at 14% per year, then it's going to take 35 years to grow 100x. If a company grows at 20% per year, then it's going to take 25 years. At 36%, it takes 15 years. No matter which way you slice it, it's going to take quite a bit of time. And along the way, you're going to come across all sorts of reasons why you think you should sell. The media headlines will scream that we're in a recession and it's time to get out of stocks. Smart people will tell you why you need to go buy gold or whatever else because the dollar is done for. Or sometimes people just get bored and they tinker around with things and chase the next shiny object. Chris has this quote in his book that I definitely agree with and really like. It's that investing is tough for a lot of people because they expect they can trust the opinion of experts. Yet in the world of markets, the so-called experts get an awful lot wrong, end quote. There always seems to be market forecasters that think they can time the market or time when the crash is going to happen or time when to buy and when to sell. There are countless studies that actually show that forecasters are wrong an awful lot of the time. Not even Warren Buffett, the world's greatest investor, pays attention to market forecasts. Here's a quote from his 1994 shareholder letter. "We will continue to ignore political and economic forecasts which are an expensive distraction for many investors and businessmen. 30 years ago, no one could have foreseen the huge expansion of the Vietnam War, wage and price controls, to oil shocks, treasury yields fluctuating between 2.8% and 17.4%, etc. But surprise, none of these blockbuster events made the slightest dent in Ben Graham's investment principles, end quote. And patience isn't just required in holding these types of companies. I think you also need patience in finding them. With thousands of different stocks available, we want to be a bit picky in what we decide to allocate our hard-earned capital towards. Don't be willy-nilly with it and just put your money in the first thing that grabs your attention. One interesting idea related to this is Sosnoff's Law, which essentially states that the best ideas are often the simplest. If you have to do a lot of homework and you have to do a ton of in-depth research to really understand a company and its industry, then it probably isn't going to be a great investment, at least according to Sosnoff's Law. Now, another really important part of understanding how these companies do so well is understanding their moat and their competitive advantage. What are they able to do that no other company can do? Here's what Warren Buffett had to say about moats in the 1995 annual shareholders meeting.
The most important thing what we're trying to do is we're trying to find a business with a wide and long-lasting moat around it, protecting a terrific economic castle with an honest lord in charge of the castle. And in essence, that's what business is all about. I mean, you may want to be the lord of the castle yourself, in which case you don't worry about that last factor. But what we're trying to find is a business that, for one reason or another, it can be because it's the low cost producer in some area. It can be because it has a natural franchise, because of service capabilities. It could be because of its position in the consumer's mind. It can be because of a technological advantage. Any kind of reason at all that it has this moat around it. And then what we have to decide is all moats are subject to attack in a capitalistic system. So everybody is going to try. If you've got a big castle in there, people are going to be trying to figure out how to get to it. And what we have to decide, and most moats aren't worth a damn in capitalism. I mean, that's the nature of it, and it's a constructive thing that that's the case. But we are trying to figure out why is that castle still standing? And what's going to keep it standing or cause it not to be standing 5, 10, 20 years from now? What are the key factors, and how permanent are they? How much do they depend on the genius of the lord in the castle? And then if we feel good about the moat, then we try to figure out whether the lord is going to try and take it all for himself, or whether he's likely to do something stupid with the proceeds, etc. But that's the way we look at businesses.
So as Buffett alludes to there, the fundamental law of capitalism is that when a business is earning above average returns, there are going to be companies out there that try and do the same and try and eat that company's lunch. So there needs to be something special about the business that keeps competitors from going in and eating its lunch and driving down those returns. The moat could be a great brand, it could be customer mindshare, a cost advantage, network effects, switching costs, a scale advantage, or potentially other reasons as well. When you do find these fantastic businesses with strong moats, the market typically tends to recognize that it's a quality business. So these types of businesses tend to trade at a premium to the overall market. And remember that moats are not always permanent. Moats can come and go, just like great businesses can come and go. If you looked at the top 10 companies back in 1993, only ExxonMobil is still in the top 10 today. So great companies back then aren't the great companies of today. It's also a good reminder that many of the companies that people thought had impenetrable moats may eventually fall by the wayside in 10 or 20 years' time. One thing that Chris also likes to look for in stocks is to look for a consistent track record of earning high returns. In general, winners tend to keep on winning. This is a much more reliable approach, in my opinion at least, than trying to get into a turnaround situation where the business is reinventing itself in a way. I'd also like to mention some caveats and other things to consider here. There are, of course, some issues when analyzing these 100 baggers and these winners in this way. One of the big issues to be aware of is survivorship bias. The study only looks at the winners, but it doesn't look at the companies that rose and then fell by the wayside. There were likely countless other companies that looked like really good investments, and they had these similar characteristics to these 100 baggers, but they ended up being bad investments had you held on the entire way. There's also hindsight bias. It's easy to look back today and say that, of course Amazon would do as well as it did. In reality, if you rewind back to the 2000s, most people were pretty skeptical of Amazon, and they said the company was overvalued and likely not to be a great investment. Investing in 100 baggers is oftentimes much more difficult when done in real time. And Chris rightly points out that investing is more of an art than a science. You'll never find a way to successfully invest in stocks that says to look for these exact characteristics if you want to make a ton of money. There's no easy way to wealth, but hopefully insights can be gained from studying the winners of the past. Mayer writes in his book, "We're looking for insights and wisdom, not hard laws and proofs." If you enjoyed this video, I'm sure you'll also like the podcast that I host called We Study Billionaires, where we study and interview the world's greatest investors and businessmen, and then share the things that we learned. We Study Billionaires by the Investors Podcast Network is the #1 stock investing show in the world, with over 120 million downloads since its inception. And if you're interested in finding 100 baggers, you may also be interested in checking out the community that I help run called the TIP Mastermind Community that we'll be sure to link in the show notes below. The TIP Mastermind Community is an exclusive community of like-minded investors that offers its members a ton of benefits. We have weekly live Zoom calls. We bring in special guests that our audience generally doesn't have access to. There's a community forum with a number of company write-ups. We have live events in New York City and Omaha during the Berkshire weekend. Plus, you get access to a few of the podcast hosts here at TIP, including myself. If you're interested in checking out the TIP Mastermind community, you can go to theinvestorspodcast.com/mastermind to check it out today. That's theinvestorspodcast.com/mastermind. Many people in the community, along with myself, are on the hunt for the next great business that still has a really long runway for growth ahead. And I've really enjoyed it because the group has allowed me to discover a number of companies that I feel I otherwise wouldn't have probably found. We like to keep the group fairly small and tight-knit, so if you have any questions about it or feel that you'd be a great fit for the group, you can also feel free to send me an email at clay@theinvestorspodcast.com. All right, that's all we had for today's video. I really appreciate you tuning in and hope you enjoyed it. If you did enjoy it, please do me a quick favor and click the like and subscribe button below. That will really help support our channel. I'd also encourage you to check out my conversation with Chris Mayer on the We Study Billionaires podcast. He's the author of 100 Baggers, super smart guy, super thoughtful, and overall just a great person. So I think you'll enjoy that chat as well. That is episode number 543 on the We Study Billionaires podcast. Happy hunting and best of luck. Guy knew that in order to achieve fulfillment and be at peace with himself, he needed to do what he truly believed was right, rather than doing what others thought was right. Whether that be growing his fund as large as it can be, living in New York City, or going to such and such events, or how he spends his time, he decided that the best way to live his life was to live by an inner scorecard and do what he believed was truly right, rather than judging his success or being at peace based on what other people thought about him.